All right, moving right along, the last indicator we're going to talk about here in Chapter 3 is the Moving Average Convergence Divergence Indicator, or the MACD. Now, the MACD is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period EMA from the 12-period EMA. So the first thing you're going to want to do is, again, go to the little f of x, type in MACD, and it should be the first one that comes up. Go ahead and throw that in your favorites if you want to. Again, you know, the practice chart tool that is down at the bottom of this chapter does have it already incorporated. So you're going to click on the MACD, it's going to add it to your chart, and the MACD looks like this. And if you look at the settings, it comes set to the fast length, which is the 12-period EMA, and the slow length, which is the 26-period EMA. So the slow period is what's also known as the MACD line, and the fast length is also known as the signal line. So the style, this is what it looks like. You can use it with or without the histogram. I recommend using the histogram. It gives you a better idea of when price may be reversing from an uptrend to a downtrend, or from a downtrend to an uptrend. So this is what the MACD looks like. Let's go ahead and blow it up here. This blue line, again, is your 26-period EMA. This is your MACD line. This red line is going to be your signal line, or your 12-period EMA. And just as we did with the stochastic, we're going to do the same thing here. So each cross of these lines, so when the MACD crosses up of the signal line, that is a bullish cross. And when the MACD line crosses down the signal line, that is also a bearish cross. Traders may buy when the MACD line crosses above its signal line, and sell or short when the security or asset or stock when the MACD crosses below the signal line. That would be a bearish cross. We just talked about that. Moving average convergence divergence indicators can be interpreted in several different ways, but the more common methods are crossovers, divergences, and rapid rises and falls. So just to review here, the MACD is calculated by subtracting the 26-period EMA from the 12-period EMA. MACD triggers technical analysis signals when it crosses above to buy or below to sell. This is bullish and bearish crosses its signal line. The speed of crossovers is also taken as a signal of a market being overbought or oversold, and the MACD helps investors understand whether the bullish or bearish movement in price is strengthening or weakening. So this is more of a momentum indicator. It's letting you know the strength of the trend. Now, the MACD has a positive value whenever the 12-period EMA, indicated by the red line on this here price chart, or the signal line, is above the 26-period EMA, the blue line in the price chart, and a negative value when the 12-period EMA is below the 26-period EMA. So when you get a bearish cross, the MACD line is below the signal line, and when you get a bullish cross, the MACD line is above the signal line. Now, in this chart, in the handout, you can see how the two EMAs applied to the price chart correspond to the MACD line down here. It's really almost the exact same thing. So the MACD is often displayed with a histogram. So traditionally, you know, you didn't get the histogram in your MACD, you just got the signal line and the MACD line. But when you add the MACD indicator in Tradingview and other charting tools, you will get this histogram that is displayed down below. And this basically just graphs the distance between the MACD and its signal line. So if the MACD is above the signal line, the histogram will be above the MACD's baseline. So when the MACD crosses above, you get the histogram also coming to the upside here. And it's also default, it's signified by this green movement to the upside and a red movement to the downside, signaling a downwards price action. So again, the MACD is above the signal line, the histogram will be above the MACD's baseline, and conversely, when the MACD is below its signal line, the histogram will be below the MACD's baseline, and traders can use the MACD's histogram to identify when bullish or bearish momentum is high. Moving on, so as shown in this chart in the handout, when the MACD falls below the signal line, this is also known as a bearish cross. It is a bearish signal that indicates that it may be time to sell. Conversely, when the MACD rises above the signal line, this is a bullish cross. The indicator indicator gives a bullish signal, which suggests that the price of the asset is likely to experience upward momentum. Some traders wait for a confirmed cross above the signal line before entering into a position to reduce the chances of being faked out and entering into a position too early. As I mentioned in the previous lesson, you want to not front run these indicators, as it can definitely get you in trouble. Now, crossovers are much more reliable when they conform to the prevailing trend. If the MACD crosses above its signal line following a brief correction within a longer term uptrend, it qualifies as a bullish confirmation. So a confirmation is something that we are going to go over in great detail in the next chapter, and it lets you know that the bullish trend is indeed a strong bullish trend, and the same thing applies in reverse. A bearish confirmation will let you know that the downtrend is indeed a strong downtrend. Okay, so what are we going to use the MACD for? We're basically going to try to find confluence for other ideas, and we're going to use things like divergences, bullish and bearish crosses, and depth of the histogram to add confluence to other ideas. Now, if the MACD crosses below its signal line following a brief move higher within a longer term downtrend, traders would consider this a bearish confirmation. Okay, so quite the opposite of the bullish confirmation. So divergences on the MACD are very important, and when the MACD forms highs or lows that diverge from the corresponding highs and lows on the price, it is called divergence. A bullish divergence appears when the MACD forms two rising lows that correspond with two falling lows on the price. This is a valid bullish signal when the long-term trend is still positive. Now, some traders will try to look for bullish divergences even when the long-term trend is negative, because they can signal a change in trend, although this technique is less reliable and will produce more false signals. Now, when the MACD forms a series of two falling highs that correspond with two rising highs on the price, a bearish divergence has been formed, and a bearish divergence appears during a long-term trend, one that is considered confirmation when the trend is likely to continue. Now, some traders will watch for bearish divergences during long-term bullish trends because they can signal weakness in the trend. However, it is not as reliable as a bearish divergence during a bearish trend. Now, MACD rapid rise and fall. When the MACD rises or falls rapidly, the shorter term moving average pulls away from the longer term moving average. It is a signal that the security is overbought or oversold and will soon return to normal levels. Now, traders will often combine this analysis with the relative strength index or other technical indicators to verify overbought or oversold conditions. Now, it is not uncommon for investors to use the MACD's histogram the same way they may use the MACD itself. Positive or negative crossovers, divergences, and rapid rises and falls can be identified on the histogram as well, and some experience is needed before deciding which is best in any given situation, because there are timing differences between signals on the MACD and its histogram. Okay, so bullish and bearish crosses, the most basic way to use the MACD. As you can see here, this is a bullish cross followed by a positive move in the MACD histogram. The same thing here, a bearish cross typically is then followed by a negative move in the MACD histogram. Now, you can see this does correspond with price. When price is moving to the downside, you get this negative movement in the histogram, and conversely, when price is moving to the upside, you get this positive movement in the histogram. Now, you may also notice that there are different types of negative movements in the MACD. In a strongly trending market to the upside, you're going to get these small negative movements in the histogram. This is just letting you know that the trend is strong, and it's giving you bullish confirmation, letting you know that the trend may continue to the upside. So what are some limitations of the MACD? Well, one of the main problems with divergence on the MACD is that it can often signal a possible reversal, but then no actual reversal actually happens. It produces a false positive. False positives are fairly common with the MACD. However, it is one of the easiest indicators to read and to use, which is why all new traders really should start with learning what the MACD is and how to read it as an indicator. Now, the other problem is that divergence doesn't forecast all reversals. In other words, it predicts too many reversals that don't occur and not enough real price reversals that do occur. False positive divergence often occurs when the price of an asset moves sideways, such as in a range or triangle pattern following a trend. A slowdown in the momentum, sideways movement, or slow trending movement of the price will cause the MACD to typically pull away from its prior extremes and gravitate towards the zero lines, even in the absence of a true trend reversal. All right, so that's all we have here for the MACD. Let's actually go over some examples. So we talked about different ways to read the MACD for adding confluence to trading ideas. Okay, so for example here, one divergence that we have talked about in pretty great detail is the hidden bullish divergence. Now, looking at this chart, go ahead and see if you can spot the hidden bullish divergence. I'll give you just a minute. Okay, so not exactly a minute, but if you are able to spot it, you would have easily spotted it by now. So what we're looking for in a hidden bullish divergence, that lets us know trend continuation is likely. We're looking for a low and a lower low in the oscillator or indicator, and we're looking for a low and a higher low in price action. This is a very strong hidden bullish divergence here. This is letting us know that it is likely the trend is going to continue to the upside, but it is not a solid indication as it will do so. So we do have to be careful that we may get a trend reversal, and this hidden bullish divergence can quickly turn into a bearish divergence.